Peter Rsi is with you. Stock Market Cycles update for Friday, March 12th, being recorded Friday, March 14th. This actually is not going to be just a daily update. This is going to be very much an in-depth update on a lot of things going on. So if you're a real market aficionado, sit back, relax. It's going to be a long one, folks. If you're just wondering what's going to happen in the market the next couple of days, you can skip forward till you find something you want, but this is going to be a very important update. We have decided that we're going to put it on both our own paid subscription file and YouTube, but in fairness to our paying subscribers, it will not go on YouTube for a few more days. You're going to get to see it this evening or tomorrow morning or whenever you choose to watch it. But it's going to be chock full of some very important information, okay? I told you last week that I was going to try and give you some kind of estimation as to when this market might top. And I had a pattern in mind, but I looked at that this weekend and I might be changing my mind. I don't know. This is something I want you to see. In the stock market, going back 100 years, and here's 1921, back at the beginning of the chart, there has been an amazing tendency for the market to reach important intermediate and longer-term turning points 150 months, plus or minus 1 or 2 months, away from a prior turning point. Sometimes it precedes it, sometimes it follows it. But the 150-month pattern has been incredibly useful and incredibly accurate. I've got a whole bunch of them up here. I don't know as I have all of them up, but where you see red lines joining turning points, they are 150 months apart. That's 12 and a half years, plus or minus a couple of months. Maybe 148, maybe 152. A lot of them are exactly 150. Let's look at a couple of quick examples. The very important top in September of 29, right up here, 150 months later, very important, one of the most important bottoms in the last century, 1942. A whole bunch of them. This is the 1937 high right here. 150 months later, led to the very important low in 1949. So this chart goes through 55, and you're saying, well, what about the current time period? Well, let me show you the current time period. This is not the current time period yet. It's just more patterns. But look at these patterns, folks. The 1962 bottom, the 1974 bottom, 150 months apart. The top in October of 68, really important one. Good intermediate to a longer term top in March of 81. The bottom in 74, the crash bottom in 87. Let's go all the way forward now. Here we are in real time. So what can you show me lately? Well, here's what I show you lately. Here's this important bottom back in July of 96. We never went lower than that point again. And here's the 09 bottom right here. Here, this one should not be extended. Look at this. The 07 high, 150 months later, bingo, the March of 20 low. So, I'm not going to go over all of them with you. I encourage you to do your own research on them, though, because it's incredible how many times, how often you see that 150-month interval between important market turns. So what did I do? And the reason I told you that one of the possibilities for an important market top would be from this low in March of 09, because it was one of the most important lows of the past 10 or 15 years. If we go forward 150 months, it takes us to September of this year. I think I have a chart of that. Here it is right here. The 09 bottom, click on this, 150 months, see the spacing at the bottom? and that takes you to September of 21. So that's one of the ideas. It's still an alive idea. There's still a possibility that we may indeed reach a top in September, 150 months. Remember, it's plus or minus 1 or 2 months. So July, August, September, October, November, in that time frame. But this past weekend, I looked at a couple of things that got my heart beating all the faster, okay? And let me show you what some of them are. First of all, I am not a fundamentalist. To me, the market and the timing of the market is 98% technical and cyclical, and maybe 2% to do with fundamentals. But there are times when fundamentals become more and more important. And to me, one of the best fundamental analysts in terms of market valuation is John Hussman of Hussman Funds, Hussman Econometrics. John has some fabulous charts on his website in his latest market commentary, and I'm going to show you some of them. I want to give him attribution because they are his charts. But let's take a look at some of the Hussman charts, and you'll see why I'm so interested all of a sudden. Margin debt divided by nominal gross domestic product. So it's not just margin debt, because obviously as the market grows bigger and bigger, margin debt's going to grow. This is in relation to GDP. So you have a ratio that you can apply to any other period in market history. And this goes back to 59. So we're talking about over 60 years now. Notice that the margin tops out at important highs. Here's the pre-crash high in 87. Here's the way, way up high in March of 2000. This led to an 83% decline in the NASDAQ. Here's the July of 07 high, actually October of 07 highs. That led to the greatest S&P decline since the 1930s, since the Great Crash. Here's the January of 18 high. It held the market up for a year or so, but didn't turn out to be a very important high. And here we are. And this, mind you, is of a couple of months ago. This is December of 2020. Imagine where we are now that we've rallied even more. So, take this into consideration. Now, can you use this for market timing? No. No, you cannot use it for market timing. But when you see numbers up here, don't be looking for what many people will tell you is going to be a new bull market. This is one of the most, in fact, it is the most incredibly overvalued market in our history. Let's take a look at another Hussman chart. Total U.S. equity market capitalization. Now, that's based on the Wilshire 5000. The Wilshire 5000 includes every actively traded stock in the USA. And they add on a 2% growth, 8% annualized nominal GDP. The historical median, the norm for this ratio is 0.78. Where would that be? Well, you can see as well as I can, but here's 50 and here's 100. 75 would be about here. So here's 0.78, where my cursor is, the horizontal line. That's the median going back to 1945 when this chart begins. So now we're talking 75 years, almost 80 years, okay? Look where we are now. There. There's no parallel in history for what we're looking at now. This is where we are now. Now, remember, you cannot do market timing with valuation models. I mean, if you go back here, back in 2018-19, you say, oh man, this is it. It's the end of the bull market. We've gone new all-time highs in this ratio. Or back in anywhere in this time zone. No. You would have sat there with your thumb in your mouth saying, why isn't the market topping? So we'll talk about that in 1 second. One more chart to show you. By the way, in that last chart, if we go back to the median, not undervalued. Go back to the median. You're talking about a 70% decline in the market to bring us back to the median. Think about that. Okay, this is the last chart. And again, these charts are from John Hussman Strategic Advisors. Wonderful charts. I think John does the best valuation work in the industry. But look at this. The median price divided by revenue ratio of the S&P 500 components. So you take the 500 components of the S&P, what their price is, and then you divide it by revenue. Makes sense to me. Revenue is money that's taken in by these corporations. Notice again, the high in 07, the high in 2000 was not a distinctive one. It was a spread out over time. But then, of course, you got the 2009 decline, and now look what's happened. At this point, in 2012 or 13, we went to new all-time highs. And now look where we are. So, does that mean the market tops right here? No. But here's the thing. Here's the thing, folks. When this matches up with what could be important cycle projections being met, longer-term cycle projections being met, then some magic may start to occur. Then you may start to see the importance of these valuations in relationship to what's happening in the market. So that's where we're going next. What's happening in the market? I'm going to do something different this week. I'm going to look at weekly charts. We haven't looked at weekly charts in a long time. And basically the weekly charts, we use the same nominal cycle lengths and the same projections, but the weekly charts are handled slightly differently. Let me show you a weekly chart and I'll show you what I mean. Okay, here's a weekly chart of the S&P, and the offset is 20 to 20.01. Now, basically, the only reason we put 20.01 in there is because the software will not accept two of the same. I would have put just 20 weeks in because that's what we use for weekly projections. We don't have a range of 18 and a half to 22 weeks. We use 20 weeks, and the way we distinguish it from the dailies is we do a plus or minus 10%. That was the original Hearst work. He did 5-week offset, 10-week offset, 20-week offset, 39, 40-week offset, and came up with an exact single number based on a single offset, but then added plus or minus 10% to that. So that's what we're doing on this chart, and isn't it starting to get very interesting? This is the S&P. I added a little chunk on here because I did a statistical reading. Let's take a look at statistics. So statistics are not very good, 57%. But if you start going average percent of ATR, you can bring that very quickly up to about a 70, mid-70, 75%, okay? So that's what I did. Brought it up to, I think, around 75%. And then I subtracted. What you do is you take that percentage and multiply it by the average true range at the time the projection's given. And here's the average true range down here. You can put that in. Those of you that have TradeStation or almost any other technical tools can put in an average true range. And so this is stuck on here, okay? Now, we obviously have entered that area, but let's forget about that area for now and look at the general projection. I want to show you how these weekly projections differ from the daily. Notice right here, projection margin in percent, 10%. So what it does is it gives an exact calculation. That's this horizontal line right here. And then it adds 10 and subtracts 10%. So that the projection calls for 39.55 to 43.46. Now this is a 20-week offset. It's the equivalent of the 98.4 to 110.6 that we do on the daily chart. But we've reached that. I don't even have to zoom in. The high this week was 39.60.27. Here's the lower end of the projection window. So we are in the projection window on the weekly charts. The weeklies are going to differ from time to time, not by much usually, from the dailies. What we do on the dailies is we do not use plus or minus 10% because we have the two different offsets, and we use those for the extremes. But the important thing is that we have now entered at the very, very low end of the zone, the upside projection for the S&P, and it's the last upside projection. It's been in effect since way back here in July, okay? You kept hearing us say we might see some kind of short to intermediate term top, but we're not looking for an important top until we reach the nominal 40-week projection represented by a 20-week offset. Well, guess what? We just did that this week. We barely did it this week. We're not well into that territory, but we're there, okay? We are there. So that's the S&P. Let's take a look at a few other things. Let's look at the Dow. So here's the Dow, 20-week offset, plus or minus 10%, calling for 33,195 to 36,524, rounded off. The high this week, 32,793. 400 points away, about 1% away. Okay, that's how close we are on the Dow. Let me show you a few other things. We hardly ever look at the transportation average, but we're going to do it now. Now, one thing to say about this is Dow theory-wise, the transports and the industrials are confirming each other at new all-time highs. But we want to put on this chart, the transports, we want to put on a 100-week offset. That's a 2-year offset, and it represents the 4-year cycle projection, nominal 4 years. So here's the 100. Look at this. That's how close we are to the nominal 4-year projection high, okay? Just hairs away. So that's the transports. Next, IWM, representing the Russell 2000. We're going to look at two offsets here. The one you're looking at right now, 100. Again, nominal 4-year projections. This is a 2-year offset, and guess what? We're in the heart of that, in fact, near the upper end of it. IWM, the Russell 2000, is meeting a nominal 4-year upside projection. Let's change this to 39 to 40, meeting that also. Nominal 78 to 80 week projection. So IWM is meeting both the 78 to 80 and a nominal 4-year projection. We're in the heart of the projection range. Long-term projections being met. Could we say that back here when the market was still overvalued, according to those charts we looked at? Yeah, we could say it was overvalued, but we could also say we had these upside projections. Well, guess what? They are being met. That's very, very important. What else can we show you? Well, this one's interesting. Let's look at the NDX. Now, remember on the daily charts, we've been looking at the 48.4 to 55 to offset the equivalent of a 10-week offset, and we broke above it. On the daily chart, we've come back above the offset line, theoretically invalidating the downside projection. But this is the weekly chart, and the weekly chart slightly disagrees. Let's look at the web chart so you can see. You can see this line, you can hardly see it. There we go. That's a 10-week offset. 10 to 10.01, but they obviously will overlap each other. Well, the midpoint of the bar for the week is below the offset line. Technically speaking, on the weekly chart, you did not invalidate that downside projection. And that projection is right here, and it calls for the low side of 11,346 and the high side of 11,807. So there's a little bit of a contradiction here between what's happening on the daily charts and on the weekly equivalents. That's why I like from time to time to look at the weeklies. We haven't looked at them for a long time. So we're going to know quickly. It might take the full week to find out whether this indeed will remain below here and start going down to the projection. But from the weekly charts, we do have that lower projection. Okay. Because I've been showing you gold, let's look at gold again on the weekly. Here's gold. Significantly lower projections outstanding. This is the gold ETF, not the metal itself, obviously. 141 to 150.75. But watch this. Even longer, the next longer offset has now been set off. We've showed you this one on the daily, but it's been given on the weekly. Now, let's say that it won't take too much to quickly get back above here, but you need to start to see a good rally to remain above there. In the meantime, significantly lower projections for gold. 134.37 on the high side, 121.02 on the low side. So what does all this mean? I still have a couple of more charts, or at least one more chart to show you. But what this means is that what's coming together now is an incredibly, historically overvalued market at the same time that we are reaching long-term upside projections, some of them nominal 4-year projections. This has become a time to be very, very cautious in the market. We've been saying all along, and we continue to say, that we'd be very surprised if we see an important top happen immediately before we have a decline and then some divergences because of the daily advanced decline line. Let's look at that because there's a fascinating chart there. Here's the daily AD line. And as you can see right up here, we've gone to new all-time highs. Seldom in history, in fact, I don't remember ever in history, and I've got the daily AD going back to the 1920s, seeing an important market top occur as the daily AD line was at a new all-time high. And that's what's happening now. So that still argues that even though we are in big, big danger land now, because of valuation in combination with some long-term projections, chances are this is not a final high. Let me show you something I discovered with the AD line that I think is rather remarkable, a technical pattern. What I did was I went back and at the beginning, let's start with the 2016 low. Okay, here's the 2016 low on the daily AD line. It immediately had a big rally and established an uptrend. And it established a slope for that uptrend. And that slope is based on, I'll give you the dates, September 7th of 16, that's one of the anchors, and January 23rd of 18, which is here. September of 16, January of 18. Now notice also that it was validated by being hit in this October of 17 time period. So you had a genuine slope here that hit 3 important market points and then fell away from it. And this is 5 years ago, folks, back here. And this is still 3 years ago here. But follow it forward and see where it takes us now. Look how close we are to it. And even the AD line in a smaller channel seems to be up at the top of that smaller channel. But watch what happens. This is rather remarkable. I had drawn this line in, and after I did that, I said, let's draw a trend line from the low in 16, and let's ignore this big down move here. This is the Christmas of 2018 low, okay? Let's use the next important low, which occurred in March of 20, okay? This was, by the way, the greatest decline in history in the shortest period of time from an all-time high. So a very important low, okay? And then I said, boy, that sure looks parallel to this upper line that was established. I mean, this line was established with highs in 2016 and 2018, okay? Watch this. Watch this. Again, these are exact lows, 2016 low and the 2020 low. If I parallel that line and move it up, can you distinguish that from the line that's already there? It's the magic of the market. Why do these things happen? Why would you see something like that? So, what the bottom line is, that should be telling us something about up here and how close we are to the top of this longer channel going all the way back. Does that guarantee you're going to stop at that channel? No, there are no guarantees in the market. I'm sorry. But because of the symmetry here and the fact that this line lines up virtually perfectly with this line whose slope was established back in 2016 and 2018 is rather remarkable, and to me says, hey, I know the AD line's at new all-time highs, but I also know that there should be some very, very strong resistance just up above us, okay? So, one more chart to show you. This is just looking at technicals. This is a 14-period RSI, measures momentum in the market. Above it is a monthly S&P chart. Here's the 09 bottom. Here's the 150-month pattern I showed you. Look at the RSI. This reading in the RSI, folks, in January of 18 was the highest monthly RSI reading in history. That's how great the momentum was. You don't reach important market tops on that kind of very historically high momentum. What happens is that momentum wears off as you go to higher and higher highs. So here we go, a higher high, lower RSI, a higher high, lower RSI, and around here you could have argued for a market top because not only did you have a lower RSI, you had an RSI around 70, which is perfect for a final high. You don't usually get final highs well above 70. You want to see a final high around 70. Well, guess where it is right now, folks? Go up 3 from the bottom where it says RSI, 70.04. So here we are with this incredible 3-year divergence coming up to a 70 reading in the RSI and saying, this could be trouble. Let's very quickly look at short-term charts. This is a 2.5-week offset, a daily chart on the S&P closing price, cash, 12.1 to 13.8. And this is the upside projection, 40.12 to 40.52. Now, the upper side of that projection, let's take a look on the daily chart for the long-term projection. On the daily chart, longer-term projection, the one that's been outstanding since July of last year, look at this. So the short-term projection we looked at was right around this area, 40, I think it was 40.30, I don't remember it exactly. But look how close we're coming to these long-term targets in the market. Again, I remind you, on the weekly chart, this analogous target on the daily has been met. The lower part, the very lower part of it, but nonetheless, it has been met. So we are now in danger territory. I still think because of the daily AD line that if we have a pullback from here, we can see a pullback and then a move back to new highs on the indexes, not on the AD line. But I wanted to show you a combination of all these factors going on in the market that over the last few days have made me a lot more potentially bearish than I've been in a long time. Remember, for the last 6 months and longer, since July of last year, I kept saying the market will not top until this long-term projection is met or invalidated. Well, we never invalidated it, never went below it, and now we're coming really close to meeting it. So these are very important days. And the next several days, several weeks, maybe few months, could be some of the most important market days in market history, because based on the Husband valuations, and this is where they become very important, once you get that turned down, it's murderous. It's horrible. Everyone keeps looking for a bottom that never comes. And if the market does not go down 70% from the high, I'll be surprised. And I will not be surprised to see it go down as much as the 29 to 32 decline, which approaches 90%. I know that's dramatic, but based on everything we're looking at here, that's what we're looking at. Could it start tomorrow? Well, because we're reaching projections, it could start tomorrow. Chances are no because of the AD line, but we are now in very, very cautious mode, and that's why I thought this update was so very important. I hope you found it important, and I hope it lets you prepare for some things that may not be so sweet to occur in the relatively near future. Thanks a lot for watching. I apologize for the length of this, but I hope you found it useful. For our regular subscribers, we'll be doing our daily update within the next day or two. Thanks for watching.